Hey everybody, Brian here from quantlabs.net. Okay, so I'm going to look at today being May 16, 2016. What I'm about to show you is what I'm going to be demoing tonight live for my QuantLeap members. This script I'll be demoing and walking through to showcase the potential of the script for looking at forward-looking data from the U.S. St. Louis Fed. It's all forward-looking data. Really important stuff because what it highlights will show you a lot of cool stuff. So let me just show you what one of the data sources, all from the same source for free. And of course, what we have here is the data that you can download from the US Fed going back as far back as the 70s, whenever they started recording it. It does download the raw data, so you can get access to it. The charting is very primitive, very basic, but you can do some decent analysis to dig deeper into looking for opportunities in the U.S. market for hot, what I call hot, profitable, what are about to be profitable trading sectors in the markets. So let's get to it. Okay, so first of all, this is the script itself. I'm not going to go into details with this. You can get this script if you're part of my QuantLeap membership service. Again, I'll be only demoing this live once and once only. Tomorrow night, Tuesday, May 17th. There'll be a video playback on it. I've done this in MATLAB as well, but this is where I'm actually doing it in Python as well. Now, the cool thing about the US is obviously got the highest volume for trading, and it's also the most liquid. For equities, this is really good for equities, but it can also be used, this type of data can also impact Forex trading when you use the US dollar as the base currency for whatever other currencies that you want to trade in terms of Forex. But I'm not going to get into that for probably a couple of more weeks. But this is just specifically right now for equities and equities only. I've shown all the details on it, be it if you want to track ETF or mutual funds or stocks themselves. You can do this using this type of data. Okay, so what we got here is the this script will download all the what I would consider major sectors in the market using different types of data sources from the U.S. St. Louis Fed. So these are the data as well as it will generate a little, as I said, primitive chart. But the cool part is I'm going to show you what we're talking about here. So these are the charts. I'm going to make these available for download for anybody who's interested in seeing this data set that was generated again on May 16, 2016. So here's an example. The title, Continued Claims Insured Unemployed. You can see it pretty well peaked in 2008, has come down pretty well down to pre-2007 levels. Good. We now move into more manufacturing, which is really important, obviously, because this shows trends. Now, again, the data sources where these come from are usually some association, a university, and it's usually done with a survey going out to whoever it is and just getting a poll on how they feel for the next 30 days or the next week or whatever the time period they're reporting on. So this is important data to use for forecasting for potential hot market sectors. This is how the professionals do it. But having this script in Python will save you a ton of time. So let's take a look at this one. This is the manufacturing new orders durable. Durable meaning hard products. These are not services or, but you can see here that it's been kind of just choppy for the last little while. Now I can break down these charts if I want, just only report the last year, the last 2 years to get a better idea. But I like to also see the historical business cycles of all of this because you can see the impact it has here, the impact here. I always thought this was like a joke, but that data is there and it has to be correct, and it's been there since that was reported. So don't ask me. But the real period you're really worried about is right in here, where it's been sort of choppy. So let's continue along. Now, the GDP is obviously pretty important. It's been on a climb. It has dipped around 2008. So that's good because you will see warning signs here. But the GDP is usually reactionary. It's not really good for kind of forecasting, but it's a good benchmark to use when you're using other Fed data to measure against the GDP. And when you start looking at that Fed data with the GDP, you'll see the cycles, and it's usually 85% dead on from a historical point of view. So continuing along, we've got the industrial production. So here it's again important. You can see it's declined a little bit, but I'll show you some other important uh, charts as well. But the thing you got to be really concerning is the how fast these drops are. You can see this is a steady drop, so it's not too concerning when the drop is really sharp, as you can see in the '08 and '01. Okay, but once this starts to tail off, you need to be aware that the markets are going to turn from a demand perspective. So this could drop, but it's descending, which is not too worrying, but it's a slow drop. But nonetheless, it's not growing either. So be aware of that. All right, so here we're looking at production business equipment. Again, it's dropped off a little bit. Um, so there's really no cycles you can get from this, but I, somewhere along here historically, this needs. I think it's the floor is just going to get lifted out and it's going to drop. I don't know when and how, but something's going to come along and a catalyst is just going to drop. It's just showing those signs right now. Continuing along, production durable consumer. Now this is interesting because what I showed you is production for business manufacturing. This is for consumer. It's doing pretty good. It's still in an upswing, and that's a good sign. So that's a good thing on the consumer. And there's some consumer report or charts I'll show you that confirm this theory. Okay, so now we're looking again at production. You can see it's flatlining. The increase in how fast it's increasing historically is not as doesn't ascend as fast. So that means you definitely slowing down on the manufacturing side, on the production business manufacturing level, not the consumer, but the business. Here's another one, production material. Now this, I think, is an early warning sign. Production material are there's, let's say you look at steel versus cars, okay? This right here is probably an early warning sign of what you can look for in what will happen in 6 months to a year, because these are your input costs of manufacturing. So for instance, as I said, let's say you're looking at steel as an input for part of the value chain going into the car manufacturing. You have at one end, the early end, the steel manufacturers, they refine it or smelt it down or whatever, and then they have to pass that along. So that's an input now going into steel, into car manufacturing. So if this is dropping fairly early, don't be surprised. You'll start to see the general manufacturing for businesses slow down as well. So that is right there, a fairly steep drop, and I think that's a warning sign of what to expect in, let's say, 3 to 6 months, as I don't know, GM and Ford or some of the airline or airplane manufacturers like Boeing will start to really slow down. And although they are slowing down, but not as much. But you will start to see it, and I think it's because of this kind of chart. Continuing along. Okay, so this one, again, it's a tough one to say. I don't know if this is just due to coal, because we know coal is dying off. But that's a pretty steady drop. And is that because there's less mining happening in the US? And a lot of it's getting imported. But there is a chart that will confirm my theory on importing. Okay? and I'll try to adjust that. But that's a scary chart because up till 2012 we had a nice rise, and now we're getting a fairly scary drop, and it's a lot steeper than in '08. Okay, so remember that. Okay, here's another one, manufacturing PMI, and this is literally the confidence of how manufacturers feel with the PMI. Okay, so there has been a drop, but you can see right at the end here, all of a sudden the confidence is coming back. I don't know what to make of that because that to me is very confusing. But again, maybe it may drop, but it may bounce back. I don't know, but my theory says otherwise. So let's check out what else we got. Backlog. Okay, this is a really important one. Check it out. Here we got some manufacturing, so they're working off the inventory. All of a sudden, manufacturing is now stopped, and inventories are starting to rise. So that means if we have this sudden rise here in inventory, that means I really think um, that there's less manufacturing, there's less consumer demand, and that's a big increase. So again, that's another huge potential of a major slowdown coming when now the manufacturers got to now work off that inventory and hope that the consumer level or other businesses are going to work down those inventories, even though manufacturing is slowed down, is now really dependent upon consumer demand to work off these inventory levels. Okay, but again, you can see how cyclical it is just since 2013. But again, um, here in '08 and '09, it did drop, but it did bounce back again. Okay. Oh, I'm sorry. I got this confused. I'm sorry. I'm looking at I thought this was the inventory. No, this is a backlog of orders. No, actually, that's a very good sign because I'm like looking at this dropped, but this is now bounced back. Actually, that means there's manufacturers lining up to get this um, manufacturing done, but a lot of manufacturers have not kept up to date with those manufacturing orders. So that's actually a really strong sign on the manufacturing side. Duh, what can I say? That's a huge different way of thinking. Okay, let's take a look at another one. Customer inventory. So this one's customer inventory is going down. So that means that there's enough consumer demand to drive down that inventory. That's a good sign. Continuing along. Manufacturing employment index. So you can see it's dropping. So as more need for manufacturing, so does the employment, and it drops. Oh, let me just go back here. But again, you can see again the business cycles that in the proper time. So it is dropping, and who knows if that's a business cycle? Do we expect another drop like in '08? So again, are we talking about this kind of drop? Or are we talking about this kind of drop? Or are we talking about this kind of drop in '09? Who knows? But again, that's definitely some kind of warning sign. Sometimes I gotta get my interpretation right. All right, export order index. Okay, so this is another confusing one because here it's been dropping for exports, but it's just been bouncing. So maybe that's because, well, over this time period, we knew emerging markets are slowing down in terms of consumption, that are going to be exporting less US product, manufactured product. But maybe, just maybe, I'm guessing here, but just maybe the emerging markets are starting to really pick up and they're importing more US manufactured product. I think that's what's happening. All right, so the next one, manufacturing inventory index. Okay, this is what I was looking for as I was confused with another one. Here it's choppy, and here we can tell that it dropped off and now it's gone back up. So again, we're seeing some trends here where it did drop off and it is bouncing back. All right. So again, manufacturing import index. I think this is a really important one as well. Imports have gone down. Okay, those are imports going into the states. It is starting to somewhat come back. So maybe again, there's some manufacturing happening um, over in a lot of the foreign lands, emerging markets. Maybe this could be related around oil. Who knows? There's no real trend to it, but I think historically you need to compare it to things in the past, and again compare it to business cycles because that's really important. And you can see every couple of years, but you just can't time it properly, precisely. So that's a tough call, but you can definitely see it is going back up. And again, it comes back to what I was talking about, where you use some of these imports coming into the states for input um, product into other U.S. made product. That part of that could be oil for all I know. Okay, manufacturing new orders. Again, look at it. It's dropped and it's coming back. So that's another strong sign that manufacturing is on the rebound. Um, so how we have here prices index. Okay, this to me would be an interesting one in terms of inflation. It is on the rise. Inflation may be on the rise. You can see it's really climbed back here, and it's starting to climb back a little bit. 49, obviously that's war related, and it goes back to those times. You can just see all that time historically, but there's really no real pattern to it unless you see some kind of political event or some kind of news event that drives this. Okay, manufacturing supplier delivery. Uh, Again, that this is a tough one to gauge from because here in '09, '08, uh, you're trying to figure out this has got to be definitely oil embargo. Here, you would expect this to have dropped a lot more, but supply side is looking okay, and I guess that's intermingling with the inventory as well in the economy. This is an important one. New orders. So non-defense capital goods. So and excluding aircraft, because when I go into Bloomberg under industrial, the big newsworthy items is always related around the car industry or aircraft, and I think they're big movers for the U.S. economy, but also for non-defense. So obviously take out wartime. It's just general other goods made in the U.S. outside of aircraft. So it seems to be flatlining. Um, can't really get anything out of that one. Total non-payroll. We've always heard about the income inflation. Or no, sorry, this is the number of people that are getting hired. That's pretty strong. Much stronger than even in '08. So that's quite a bounce back. And I really think if something happens, let's say Trump gets into power, that this will drop very quickly, just due of the lack of clarity in the U.S. markets. Permits, building permits is really important as well, because here we always knew about the rise of real estate, and it just dropped, and it's on the rise again, which is good. And you can historically see at what level does the drops take place, and you can always compare it. So let's say if it hits 1500, is that a peak? Who knows? Or is it 2000 a peak? Who knows? But you got history on your side to sort of gauge that. Okay, now this is another important one: the consumer sentiment. Obviously, consumers was already in the tank in going in '07. '08 through '11, it dropped again, and then again, it's dropped a little bit, but I've checked this lately, and it seems to be on. Oh, That's a cool little feature. If only I could figure out how to do that, because that would be useful. Oh, I'll figure that out one day. But yeah, it's kind of, I think it's bouncing back. Unemployment rate. Well, we know about that, and it's not quite at the lowest, but this is when the U.S. was just manufacturing domestically a lot. Um, so that's when they were doing really well, did fairly well here. But it is bouncing back in terms of getting a lot of people back in the job market. So that's probably why the consumer's pretty good and everybody's all happy. So generally, I'll make these charts available. There is a mixed story, but it's not as bad as one would think. And we can confirm that from this data, which is really, really important instead of guessing. And again, you can check out where you think the hot sectors will be. And obviously, from what I'm seeing, I think that anything consumer is pretty strong to get into. I'm not going to make any calls tonight on it, or I'm going to wait till maybe next week and make some calls as I work on showing the script that does all this next Tuesday. Okay, so I just want to show you that and what you can do with this type of data coming from the U.S. Fed or St. Louis Fed. Over and out. Hopefully, I'll be helpful for you. And as I said, you can download these exact charts that I made available on my blog.